Hello and welcome. This lecture video will cover notes receivable. So a notes receivable contains a promissory note. Okay, and so a promissory note is a promise to pay a specific amount of money, usually carries interest, either on demand or at a definite future date. These promissory notes, which is a notes receivable, can be used in a lot of different transactions. They can be used to pay for products and services, and then they can also be used for lending and borrowing money. Okay. Also, if we're a company and we sold something to someone, we may want a note receivable, all right, to replace an accounts receivable. So let me explain that in a little bit more detail. So we sell something to someone, to our customer, and then the credit terms are that they have to pay us in 30 days. And then 30 days go by and they haven't paid us. And so maybe what our customer says is, all right, we couldn't pay you on time, so what we're going to do is we're going to sign a promissory note, and then we're going to promise to pay you back in 6 months from now, and since you have to wait, we're going to pay you interest. Okay, so that's the kind of situation that I'm talking about here, that sellers may ask for a note receivable to replace an accounts receivable for a customer who's past due. Needs additional time to pay on the past due accounts receivable. Okay. Also, for legal reasons, a seller may prefer to receive notes receivable when the credit period is really long. Why is that? Well, it's got a little bit more legal teeth to it than an accounts receivable because you're signing a promissory note. It also carries interest. Okay? It also carries interest. So that's what we're saying here. If there's a lawsuit needed to collect from that customer, you have that promissory note, and that's the buyer's written acknowledgement of that debt and then the terms. So when you look at this little, this figure showing the promissory note, this picture showing the promissory note, we have our amount, that's the principal. Here's the date of the note. This is going to be the maturity date, 90 days after this date. And then this is how much you got to pay, right? Here is the annual interest rate. The annual interest rate, remember that's stated on a yearly basis. And then here is the maker of the note, okay? The one who signs the note down here, okay? So one of the things that we have to look at and I'm flipping ahead to page 197 here, is how to calculate the maturity date. So that's the date that the buyer has to pay us. So remember, we're on the seller standpoint here because we're talking about a note receivable. So we have to figure out, well, here's the date of the note, and then the buyer says, we'll pay you in 90 days. Well, what is that exact date? Well, that's just involves looking at the calendar, right? Looking at the calendar and adding up the number of days to get to the maturity date. Okay, so let's look at that on the next page, 198, right over here, calculating the maturity date. So let's say on July 10th, 2011, TechCom received a $1,000 90-day 12% promissory note as a result of sale to Julia Brown. This is a 90-day note dated July 10th. It matures October 8th. How did we get to that? Well, there's 31 days in July, minus the 10 days in the note, which means there's 21 more days in July. There's 31 days in August, 30 days in September, and then we have to add 8 more days in October to get up to the 90. So it basically involves looking at the calendar, remembering how many days are in each month, and adding up the number of days to get to that 90 days. Okay? That's the way we figured out. All right. Let's talk about the next thing, which is calculating interest. Now, remember, this is dealing with notes receivable. So we're talking about calculating interest revenue, not interest expense, because this is a note receivable. So we're on the seller side here, or on the lender. We're either selling something or lending money. And so, all right, so where was I? My phone rang there for a second. So now I'm back. So what we're talking about over here is calculating interest revenue, right? So how do we do that? Well, we talked about this back in a I believe it was probably chapter 3 when we're talking about calculating interest expense. In this case, we're talking about interest revenue. So it's the exact same formula. So we can see that in this figure right over here. We take the principal of the note times the annual interest rate times the fraction of the year. Because remember, that interest rate is stated on a yearly basis. So if you said for this Julia Brown promissory note that we just talked about, that $1,000 12%, if you multiplied 1,000 times 0.12, well, that would give you the interest for the full year. But remember, she gave it to us only for 90 days. She's going to pay us in 90 days. So then we have to take the fraction of the year, which in this case is 90 divided by 360. Remember, we use a 360-day year for interest calculations. So it's our 1,000 times 0.12 times 0.25, 90 divided by 360 is 0.25, gives us $30. So this would be our interest revenue, $30, okay? In terms of recognizing notes receivable, let's talk about some of those journal entries. Notes receivable are usually recorded in a single account to simplify record keeping. The original notes are kept on file, including the information on the maker, the rate of interest, and then the due date. If they hold a large number of notes receivables, they could set up a subsidiary account for notes receivables, just like what we did for accounts receivable. But they probably only do that if they hold a large number of notes receivables. Okay, and again, getting back to why a company would want to use a notes receivable, they can use it to extend the due date for an accounts receivable. They could use a notes receivable when they lend money to another party, or they could just say we're going to use notes receivable to recognize a sales on credit. So rather than debiting accounts receivable, they would make the sale on a notes receivable. Maybe they're making a sale to a customer who in the past hasn't been that credit worthy, and so rather than giving them accounts receivable that doesn't have any interest, we're going to say, nope, you're going to sign a promissory note and you're going to pay us interest if you want credit with us. Okay, so those are some of those reasons why a company might use a notes receivable rather than an accounts receivable. But let's come back over here and look at our journal entry for our promissory note, our notes receivable from Julia Brown. So remember that example, we had that $1,000 90-day 12% promissory note from Julia Brown. Let's talk about that journal entry. So we come over here, and it was on July 10th, so we say our 7/10, and we're going to debit notes receivable, our $1,000, right? And then we credit sales for $1,000. So it's basically a sale and credit, right? Just like what we did with accounts receivable, but rather than debiting accounts receivable, we debit notes receivable. Okay? So let's talk about two different situations that Julia Brown pays us on time, which means the note is paid on maturity, which is called recording the note is honored. And then we'll talk about the situation when the note receivable is dishonored, which means that Julia Brown does not pay us in 90 days. Okay, she's late, and that would be the note is dishonored. So when we look at the note is paid on maturity, J. Cook has $600, 15%, 60-day note receivable to TechCom. J. Cook pays TechCom $615, which includes the interest, $600 for the note receivable, and $15 for that interest accrued. Okay? So let's look at that journal entry, and we'll actually write it out. And let me show you how we calculated this $15 in interest. We take our principal, 600, times our yearly interest rate, times 60, divided by 360, and that gives me $15. Okay? So when we get paid, and we're TechCom in this situation, we're getting paid by J. Cook. We come over here and we debit cash for our $615, which is equal to our principal of $600 plus our $1,500 interest. And then we no longer have the note receivable, right? Because when we made the sale, just like up here, we debited notes receivable for 600 credited sales for 600. We no longer have that notes receivable, so we credit notes receivable Just like when a customer pays us for an accounts receivable, we debit cash and credit accounts receivable. In this case, we're going to credit notes receivable, and that's for the principal, $600. Now, you know that debits have to equal credits, and so I'm missing a credit here. And what do you think that credit goes to? Think about it. If you thought to yourself, interest revenue, you're right. Kudos to you. Interest revenue for $15. Okay, so my full journal entry to record an honored note, debit cash, credit notes receivable, credit interest revenue. Okay, this is additional revenue that would show up on the income statement. This is additional revenue, interest revenue right over here is additional revenue that would show up on the income statement. All right, let's record the situation though where we don't get paid on time. Okay, so we don't get paid on time. So in that case, let's look at our situation. TechCom holds an $800 12% 60-day note for Greg Hart. At maturity on August 14th, Greg Hart does not pay us. Remember, we're TechCom. What do we do? Well, first I'm going to calculate out interest that would be owed. 800 times 0.12 times 60 divided by 360, which equals $16. $16 interest, okay? So what we're going to do when the note is dishonored is we're going to move it from notes receivable to accounts receivable. We're going to move it from notes receivable to accounts receivable. So rather than debiting cash, I'm going to debit accounts receivable. And I'm going to debit accounts receivable for the principal plus the interest. So I'm going to debit accounts receivable for $816. And remember, my abbreviation for accounts receivable is AR. So I debit accounts receivable for $816, which is the principal plus the interest. Now, I also credit notes receivable for $800, which was the principal. Credit notes receivable for $800, which is the principal. And then what does my final credit go to? Because we know debits have to equal credit. I credit interest revenue for the $16. Okay? So what I do is when we don't get paid, we don't just write it off, we move it to accounts receivable. All right? We move it to accounts receivable. Now, why do we do that? Well, first of all, that journal entry removes the notes from notes receivable and records that it was not paid. Okay, and then later on, if Greg Hart tries to do business with us again, we can check his credit and say, you have this outstanding accounts receivable. You need to pay us that before we do any business with you. Certainly, before we extend credit to you, you have to pay us, okay? That's what we're saying over here. Let's look at our final situation revolving around notes receivable, which is recording our end of period interest adjustment. So remember, the revenue recognition principle says that we record revenue when we earn it. How do we earn interest revenue? Time elapses, time goes by. So if we have a situation where, for example, on this one, on December 16th, TechCom accepts a $3,000 60-day note, 12%, we're not going to get paid our interest until the next year. But in this accounting period, at the end of this accounting period, I have to do an adjusted journal entry to recognize the interest that has been accrued from December 16th through December 31st, because I've earned 15 days worth of interest, the 16th through the 31st, in this year. And so therefore, per the revenue recognition principle, I have to recognize 15 days worth of interest. And the way I do that is on 12/31. I debit interest receivable 15, and then I credit interest revenue for 15. Okay, that's what I do. All right, so I think I'm going to end this lecture video now, and then in the next lecture video, we'll go over the journal entry when we get paid. Thanks.